Thanks for joining us today for our weekly investment audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll go ahead and start with our chart of the week, and we called this Evolving Market Leadership. And I thought this was important because there's been a lot of news flow around, are we in a potential AI bubble, an artificial intelligence bubble? And I think investors are getting a little bit hesitant because several of these names have ran really far over the last couple years. We'll talk about it here in a little bit. Valuations are a little bit stretched. So investors are worried, are we actually in a bubble? And is this going to end poorly for these companies that have been leadership? Now, we'll address whether or not we think we're in a true bubble here in a second. But one of the things that I do want to point out this week is that market leadership is always changing. So this chart here shows what the 10 largest companies were in each fifth year of the decade. So in 1985, you can see that this was made up of some energy names, some industrial type names. In 1995, some consumer names started to come in, some healthcare started to come into the index as the largest weights. And then in 2005, you can see all the blue names were brand new names to the largest 10 stocks just in 2005. That was six new names in the index. And then again in 2015, we had several new additions and some others fell off. And you can see here in 2025 that none of those green names from 1985 remain on the list. Very few of them from 2005. Only Microsoft remains on the list. And then in 2015, a couple names have fallen off as well from the 2015 time. And the reason that we show this is to emphasize that market leadership does always change. There's new themes that show up in the market, and new companies kind of rise to become the largest companies in the index. That doesn't necessarily mean that the other names do poorly, but the market does start to change as the innovation cycle changes. So if you look at, are we in a bubble, and to try to answer that question a little bit better, we've got some slides here. And it is true that the 10 largest stocks do make up close to a record amount of the index. So you can see here in the orange bars down below, that's the top 10 stocks as a percentage of the S&P 500 market cap. And you can see that that is almost 41% now. But what's interesting is that this trend in market concentration has coincided with a strong upward move in the market itself. So the pickup in concentration hasn't necessarily been a negative thing for the market thus far. I believe the concern is if these leaders stop leading, what could happen to the market? And of course, if they were outright negative, that would be a negative drag on the market. If returns just slow down, we think that that's okay here for the market. Now, equally weighted, when we look, and again, the cap-weighted index, we can see that in the dashed orange line in the top. The cap-weighted index has been on a tear. I mean, over the last 3 years, it's up almost 69% here, very strong returns. But on an equal weighted basis, we're still up 28%. So that is a far cry from the 68, 69% that the cap weighted index has delivered. But it is still an uptrend nonetheless. And the equal weighted index did recently reach an all-time new high. So we are seeing participation from the other companies, not weakness from the other companies. So we would call that a healthy condition because other stocks are also performing well. Now, thus far, the fundamentals have really supported the outperformance from the so-called Magnificent Seven. So here in the top clip, we're just showing those 7 stocks rather than the 10 stocks that are the largest. But those 7 stocks comprise about 35% of the index. That's the blue bars in the top clip. Now, the earnings weight of those 7 stocks is about 27%. So pretty close. And you can see that there's been an uptrend in the earnings weight of these index that coincides with the uptrend in the market cap weight in the index. So fundamentals have been superior for these companies, and that has been supporting the advance. Now, something to be on the lookout for, the bottom clip in this chart shows the market cap weight minus the earnings contribution to the index. And you can see that at 8%, that is starting to look a little bit stretched. So the trend has started to disconnect a little bit from the fundamentals. It's something for us to be cognizant of and to think about. But thus far, it really has been superior fundamentals that have been driving the trend in the Magnificent Seven. Now, valuations are stretched for the mega caps, and I think that's important to note, especially on a price to sales basis. So that orange line down at the bottom shows that the so-called fan mag, or six of the really large companies in the index are at an all-time high on their price to sales ratio. So valuations are certainly stretched from a top line perspective. But from a bottom line perspective, that top clip in blue shows the price to earnings ratio, and that is stretched, sure, at 33 times, but it's about in line with its average of the last 10 years or so. So not quite as stretched on an earnings perspective as these are from a sales perspective. Now, we are cognizant as well that the so-called hyperscalers, so this chart shows Amazon, Microsoft, Google, Meta, and Oracle, and you can see their spending plans by year. And this does show that the intention here in 2025, you can see a huge uptick in spending, but then again in 26, 27, 28. So the spending plans have been increasing quite a bit here for the upcoming few years, and we are cognizant of those. Those projects do have to pay off for those companies. They're making large bets here. Valuations are a little bit stretched, and I think all of that kind of adds up to having a little caution around the group, but we do still want to be allocated to these names as they've been market leadership. And it is also important to note that just because those names are stretched doesn't mean all names are expensive in the index. Now, we're showing here on the bottom clip in orange, this is the median price to earnings ratio for small, mid, and large cap stocks in the US market. And so what you do is you line up all the companies and you just grab the middle company's price to earnings ratio. And we can see that that's 26 times. That's pretty expensive, but it's really only about 2% overvalued to the index. So, or to its historical rate of valuation. So not near anything that we would call a bubble for the median stock in the index. And really, we wouldn't call it a bubble in the AI names either. So looking at Q3 fundamentals, the uptrend has really been supported by fundamental improvement. About 84% of companies had reported through last Friday. You can see the gray bar, which represents the S&P 500 index for sales on the left. Sales are up over 8% in Q3. That's a very solid number for revenue growth. And then earnings growth is up close to 14% for the index. And we can see that all sectors have been reporting positive sales and earnings growth in Q3. So that fundamental picture has really been supportive to the uptrend in stocks. Now, one of the things we're watching from an economic perspective is the effect that the government shutdown likely had, which was to result in a hit to confidence. Here we're showing the small business optimism, and we can see that there's been a couple successive months of drops. The year-to-year change is still positive, but has been weakening. So small business optimism has been starting to correct here, and we do think that that has a good amount to do with the government shutdown. Also, some of the uncertainty we've had over trade policies and what have you. But this is going to be important to watch. Is confidence going to start to rebuild now that the government's reopening and we're starting to get some of the tariffs rolled back and some more certainty around trade policy? Now, one of the things that we think could be a boost to the economy as we move into 2026 is the tax refunds from the OBBBA should pick up about $1,000 per worker next year. So that's what this chart is showing here is tax refunds per employee. And you can see that in 2025, it was about 2,200, and it's looking to be about 3,200 in 2026. That's an extra $1,000 per employee. And that's a meaningful piece of stimulus that's set to kind of boost consumption in 2026. Now, when we look at the technical action for the market, there was a little bit of corrective action at the end of last week, but the markets did finish a little bit higher on the week. We can see that the uptrends certainly remain intact. International markets have been the outperformers, about doubling up what the U.S. markets have done. But in general, the uptrends remain intact, and we really want to give the bull market the benefit of the doubt. But as a reminder, it's certainly possible that we move into some sort of corrective activity, if not probable. And I just do want to remind listeners that corrections are very normal. So this chart is showing the amount of times in an average year that the market experiences a 3% correction all the way on the left, all the way over to a 20% bear market on the right. And you can see that 3% dips have happened a little over 7 times per year. 5% corrections have happened almost 3.5 times per year. And a 10% correction has happened a little over 1 time per year in any given year. So we should expect corrective market activity, but that doesn't mean that the bull market is over. So here's our closing thoughts for the week. On the chart of the week, we did show that market leadership is constantly evolving. If we take history as a guide, many of today's largest companies may not be the biggest companies in a decade or two, and that's okay. That's just part of market innovation and cycles that happen. That says nothing for if we're in a bubble or not for AI. We don't think that we're in an AI bubble right now for a couple reasons. I mean, it is true that the cap-weighted index has been outperforming, but the equally weighted index has been in an uptrend as well. That's been a positive. And that outperformance that we've seen from the large tech companies has been justified by superior fundamentals. Now, we have noticed that market cap and earnings have begun to diverge a little bit, and that's something to watch, especially as valuations are pretty high for those hyperscalers. And their future spending plans are really going higher here, and that's something to be cognizant of as well. Are those projects going to pay off? Now, the median company is somewhat richly valued, but not close to a bubble, and solid Q3 fundamentals are supporting the bull market here. Now, the government shutdown did likely have a negative impact on business sentiment. Let's watch to see if we get an improvement in confidence now that the government's reopened and into next year as we start to get more tax refunds and lower Fed policy rates. Now, last week did see a little weakness at the end of the week, but corrections are normal. The bull market could be supported by that stimulus next year, and we don't want to fight Fed policy or fiscal policy as well. That's not a recipe for success. So that's what we have for you this week. And as always, I want to thank you for joining us and wish you a great week ahead.